This is the future of finance.
This episode is brought to you by Metis Global Partners and by the Intentional Endowment Network's 2025 Annual Forum, taking place October 27th and 28th at Goucher College in Baltimore, Maryland. Hi, everyone. Welcome to the Future of Finance podcast. I'm George Dyer, and today we have two great guests from Metis Global Partners. One is Machel Allen, who is the President and Chief Investment Officer at Metis, and the other is Brad Gretsch, who is a research analyst there, focusing on their Sustainable Real Assets Index strategy, which we talk a lot about in the episode. I was excited to have them on to talk about this because of the huge role that real assets play in the energy transition and in reducing greenhouse gas emissions. As we talk about, this covers things like natural resources, think timber or agriculture, as well as real estate, infrastructure like power generation, water infrastructure, et cetera, as well as commodities and precious metals. So many of the things that drive our economy, even if we might take a lot of it for granted day to day. But it's another great example of an investment strategy that fits into traditional portfolio management for endowments and foundations, has a strong potential for financial performance, and also really high potential for positive impact and investing in the energy transition. So I hope you all enjoy the conversation. Please be sure to follow the show and subscribe to our YouTube channel. And with that, here's my conversation with Machel and Brad. Machel, Brad, welcome to the podcast. How you doing?
Great.
Doing well.
Excellent. Yeah, thanks so much for being here. How's everything in San Diego today?
Sunny as usual.
Yeah?
Yeah.
Perfect weather?
Yeah, it was a little bit warmer yesterday, I think. I actually haven't spent much time outside today, but yeah. But a bit warmer for us is like, high 80s instead of low 80s.
Yeah, nice. Yeah, awesome. Well, we got good weather here in New England, so we're all in the same boat. But yeah, thanks again for being here. Really excited to talk about your work and everything you all are doing at Metis. And Machel, why don't we start with you? I mean, you've had a really long, accomplished career in the investment industry before starting Metis. So tell us a little bit about, kind of what prompted you to do that and go out on your own back in 2013.
Yeah, gosh, 2013. It's been almost 11 years already. How time flies, 12 years. So I spent the first 20 years of my career in big shops, shops like Brandis and Lord Abbett, and worked on the investment teams there. But even then, we just kind of had this really entrepreneurial curiosity and bent. I was always looking for different ways to do things and new things we could create. And to that end, the team that I managed at Brandis, the quantitative team, we actually built a new product suite and investment process for Brandis, with their intentions of using it as kind of a future growth catalyst. Short story long, they had a number of business events that kind of changed that trajectory. But our team really felt like we had built something that could stand on its own. And so I approached senior management and kind of pitched them our idea about spinning out and becoming partners. And they thought the idea was good. So we did that. 2023, and that was the beginning of not only Metis, but also of a 12-year strategic partnership between Metis and Brandis. They provide all of our infrastructure, so we've got a big shop back office and big shop trading floor, and that's obviously been really supportive to our business over the years. So
that's great. Yeah, no, that's huge. I was actually just had another guest on the podcast. Hallie Label from Expect Equity, who does a lot of that, like provides that kind of big shop back office infrastructure. We were talking about how critical that is. So that sounds like a great way to do it.
And it's not just boutique shops doing that. I mean, even big shops are outsourcing their back offices, and in many cases, they're trading to these institutional service providers that do just that. That's their core competency. So I really think it's we were early, maybe, but it's really, I think, the future of institutional asset management infrastructure anyways.
Yeah, great. Very cool. And Brad, how about you? I know you worked at the investment consulting firm Makita, and then you were with Nuveen for a time. What prompted you to make the leap over to Metis?
Yeah. So, I really like Machel and the rest of the team. They're super interesting people with, really diverse and accomplished backgrounds. And it just seemed like a great opportunity to be at a fast-growing boutique firm where, I could be involved in every aspect of the investment process and, learn a lot from some great mentors along the way. And then, joining Metis also really allowed me to, wear a bunch of different hats and have more wide-ranging responsibilities. And then, maybe most importantly, pair my love of investing with my passion for ESG and sustainability in a really hands-on and active way.
Yeah, nice. Awesome. We're going to dive into that. And I know, so Metis, you all have a lot of different types of strategies, including active public equity strategies from micro cap to large cap, covering different geographies. But I'm really excited to focus in on your sustainable real asset index strategy today. So first, just like on the most basic level, explain for our listeners what real assets are.
Yeah, well, we're super excited to talk about the sustainable real asset strategy today. And, when we think about real assets, it's on the most basic level. It's when you look around, it's all the things you see. It's all those tangible assets, things like land and buildings and infrastructure and commodities. And they make up a huge part, obviously, of the markets that we invest in. The way that we approach real assets is through a listed or publicly traded company approach. So basically what that means is we're going to be investing in the companies that either own these real assets or service them in a meaningful way. And most specifically, we're investing in we've listed real asset companies vis-a-vis custom indexes, which is what we're building. That's what built the case for this strategy. So it gives the investor an opportunity to invest directly in a very liquid manner into a wide range of diversified real assets.
Yeah, that's great. Because I think, a lot of people, when you think of real asset funds, it's often private markets, right, that are investing in those assets. And so to sort of have that, and that comes with less liquidity.
It just plays naturally off of, I think, one of the things that I failed to mention up front is that about 5 years ago, we went from being an active manager, which are all those strategies you just described, quantitative active manager, we still do and love, and expanded that into customized beta. As a quantitative shop, we saw the opportunity, particularly for the middle market, to provide customized, very targeted solutions to meet the individual institutional client.
Yeah. And when you say customized beta is essentially like passive index strategies.
That's right.
Yeah. So instead of like picking stocks actively, you're kind of investing in a swath of the market.
That's right. Yeah, you're getting a whole market exposure. So we offer both now, both the targeted and then the passive broad swatch.
Nice. And so can you provide some examples just to make it a little tangible of what types of companies would be in that real assets index?
Oh, yeah. Yeah, for sure. I mean, when you're thinking about the types of companies in this space, it would be, there's really 5 sleeves of real assets. And we think about the way we view the world. There's, there's real estate, there's infrastructure, there's natural resources, there's commodities, and then there's precious metals and specifically gold. So some of the obvious ones in natural resources would be things like oil companies in a traditional real asset index fund. So think people like, Chevron or Shell or something like that. Real estate would be REITs, and we all know a host of those companies. There's both transportation infrastructure, digital infrastructure, a whole range of infrastructure type companies. So whether it's, Transurban or somebody like Equinix on the REIT side, it's, these are the types of companies you're going to be investing in from
Yeah. And they're not necessarily like household names because they are just like infrastructure that people don't necessarily know the names of the companies that are doing all that.
That's right. So maybe natural resources, people like Shell and Chevron, yes.
Right.
But maybe some of the REITs or some of the infrastructure, maybe not as much.
Yeah. And REITs, for those who aren't done, are real estate investment trusts, right? Which is essentially like tradable securities that represent real estate assets.
That's right. They bundle them all up, turn it into, they securitize them so that you can trade them. That's exactly right.
Nice. And so you mentioned that like some of those examples in a traditional real assets fund might include those oil companies and stuff. What do you all think about and how do you sort of define like taking a sustainable approach to real assets?
Right. Well, this was a reference. We actually spent several years literally scouring most of the globe and looking at virtually every index methodology we could find around applying a sustainable lens to real assets. Right. And so we found some commonalities in that, kind of regardless of where you were looking in real assets. Some of the common themes we see are are carbon emissions and intensity reduction, things like overweighting transition opportunities or underweighting transition risk. And then applicability is, I think, a big one. So identifying sustainable objectives that are specific to a particular type of real asset or a particular type of industry within a real asset space. Brad, you've looked at some of the companies specifically, maybe just to follow on from that to illustrate that. Why don't you share some of the types of companies that show up in a sustainable real asset mandate?
Yeah, totally. So, our sustainable real asset strategy isn't going to have that traditional fossil fuel and energy exposure in names like Chevron or Exxon. We'll find a bunch of similar like electric utility names that generate most of their power from low carbon sources like solar, wind, nuclear power. And, some examples of those names are the more well-known ones would be like NextEra Energy or Constellation Energy Group. And, those are in the traditional real assets index, but they're going to have much higher weights in the sustainable index.
Gotcha.
Yeah. And then, we're also going to have a greater allocation to real estate companies who are more energy efficient in their buildings than peers and, have significantly lower carbon emissions. And then, some other areas of emphasis for this product are going to be miners whose businesses are mostly or wholly focused on metals essential for the climate transition. So that would include things like copper, lithium, uranium, rare earth metals. And then maybe the last thing that I would highlight here is that we have more exposure to water utilities and companies that provide wastewater services and environmental remediation.
Yeah. So when you're like evaluating those companies, those that are kind of leaning forward or providing more of the solutions for the energy transition, and that changes over time, I would imagine, in some companies. So you're kind of constantly monitoring which companies are either pushing forward in that direction or backsliding, and they go in and out of the index, or how does that work?
Yeah, so these index methodologies, that's exactly what they do, is every rebalance period typically, so that the rebalance of that index can be either quarterly or semi-annually, and they're rescoring or reevaluating these companies, kind of strengths and weaknesses in these various areas, and that can either change the weights in the index, exclude them from the index if things have really gone south, or bring someone new in. So yeah, that's an ongoing observation with these.
Yeah. Nice. That makes sense. Yeah, because these things are changing all the time. Yeah. Cool. Well, I'd love to talk about this kind of from three perspectives too. First, sort of the impact case of what, how investing in strategies like this, like the impact it has on the energy transition, and then the financial performance piece, which is obviously critical for all investors looking at this stuff, and then some of the other benefits that are just sort of unique to this type of real asset index strategy. So maybe let's start with that impact case and just sort of speak a little bit to how this can help drive positive impact.
Brad, you want to speak there?
Yeah, happy to. So, real assets are responsible for nearly, I think, 80% of all real world emissions between things like transport, infrastructure, heavy machinery, chemicals. So they really are the key to decarbonizing the economy and ensuring we can actually limit the effects of climate change. So if you're an allocator, you're trying to have an outsized positive effect or impact in the real world. I think starting with focus on sustainability and decarbonization in real assets is kind of a no-brainer. And I should mention that this isn't necessarily an impact fund per se, but broadly speaking, for a passive public equity fund, the basic theory is that investing in these companies helps support their share prices and values, which gives them the financial flexibility to execute their business strategies, effectively raise debt and equity, and then also retain and attract employees via more attractive share-based compensation. And so by doing this for real asset companies, building sustainable infrastructure and real estate projects, we can kind of do our part to make sure that these projects have enough funding and that there are actually talented people working on these issues. And, in turn, I think this will help more projects ultimately be built and hopefully speed up the climate transition in, one of the more critical areas of the economy.
Yeah, it's a great way to put it, because I think there's often this debate around how much impact you can have in public markets, because these are, secondary markets where if you sell the shares, someone else buys them and stuff. But there is that general price pressure, either up or down, if more investors are investing or not. But then that also kind of I think naturally goes to the financial performance case, because if there's a belief that we're going through this transition and this is where a lot of it's happening and the sort of infrastructure that'll get us there, you have the potential, right? Obviously no one knows the future and it's all very dynamic, but the potential to kind of ride that wave, right? If there's a lot of capital and activity and value being created in these sort of more sustainable real asset strategies.
Yep, that's right. I think that's right. And I think, the financial case was an important element of our work in this area. What we needed was to be able to identify more sustainable companies, but at the same time deliver in the type of financial performance and expectations that the typical institutional client has for the listed real asset space. And, what we saw in our simulations and our back tests is that the traditional real asset index fund of a sustainable real asset index fund largely performed consistently over the same period of time. So there really is no meaningful performance degradation at all. What we did see, though, and it's relevant, is some variability in terms of when they perform. So you might imagine with this traditional real asset index fund, we said that, for example, has a bunch of traditional energy in it, like oil and gas. Well, years that oil and gas are up or down, there's going to be variance between what we would see in the sustainable fund that doesn't have direct oil influence. But there seems to be exactly that, like an up and a down, and over the longer period, they tend to net out. Other areas besides, say, energy actually have very close correlations. So, I think that was one of the things that gave us confidence that this strategy could deliver on its role in a portfolio, was that it was actually acting like a real asset index fund while still to define more sustainable companies.
Do you see investors sort of investing in both as a way to like hedge through different market environments, or do you see mostly, investors that want that mission alignment or sort of, want the sustainable option that just choose that one?
It's an interesting question. I mean, maybe we can just reflect on what brought it about to begin with. So the Metis Real Asset Index Fund, our traditional one, we launched just about 2.25 years ago. And that was really a custom project initially that turned into a fund for a large OCIO who was looking to build a better mousetrap for kind of indexed funds. And that's been wildly successful. It's our first $1 billion fund. It crossed over $1 billion just a couple weeks ago. And so there's clearly a need and a desire for real assets, the fund. Right after we launched this fund, though, one of our large foundation clients, who is well known in the foundation space for being really out at the nadir of climate sustainable alignment across their entire portfolio, called us and said, "Machel, I think this new fund is great. Do you think you could build a sustainable version of it?" And that's what set us on our journey. So in this case, they want the sustainable version, right? And I think what we've seen in general, because we have other climate-aligned index strategies besides just the sustainable versions, is that where we have clients like foundations and endowments who want to align their investments with their larger missions and views and goals in the world, they will typically choose an aligned version of that as opposed to some of the traditional and some of the things. So I'm probably expecting to see that. We're going to have folks that will just take the traditional approach like they have already. And then we've got our clients, and there's plenty of them out there, and not just in foundation endowments, but in places like healthcare and OCIOs and family offices, who definitely, all things being equal, want a sustainable equivalent. So.
Yeah, nice. And talk a little bit about the sort of third piece, which is just some of the attributes that are unique to a real asset index strategy in terms of like some of the traditional investment considerations around how it relates in inflationary environments, some of the fees, liquidity, the diversification it gets you, that kind of thing.
Yeah, well, this is the case for real assets, and the sustainable real asset fund is no exception to this. The reason why people want listed real assets or direct, but in this case listed index, and is for a couple reasons. One is obviously capital appreciation. You want anything you invest in to grow, and these certainly do over time. Income is a big component for real assets. You're going to see larger dividends than normal typically in listed real assets. They also tend to diversify against other asset classes meaningfully. And a lot of that has to do with its inflation beta, which takes us to the fourth part about inflation. They tend to be a hedge to inflation. So as inflation rises, you'll want to be in these spaces. Obviously, we've seen that in recent years with infrastructure and some other areas, interest rate sensitive periods, real assets tend to do very well.
Mm-hmm. Can you explain like sort of why that is, or like what the dynamic there is when inflation's going up, why these assets are attractive?
Yeah, I mean, I think there's a couple reasons, depending on which way you want to approach it. And Brad, feel free to jump in on your 2 cents on this. But I think, it's in inflationary periods, interest rates go up. To stimulate markets, there's often investments in infrastructure into broader markets. That's a macro approach to that. They also have an income yield, so they become more attractive securities in periods of inflation as opposed to just a capital return because the cost of capital has gone higher. The diversification benefit as a hedge. I guess you asked me why they hedge to inflation, but these are some of the reasons why.
Mm-hmm.
Brad, those are the 2 or 3 off the top of my head. You want to add anything to that?
Yeah, I would just say in general, inflation is generally defined as more money or chasing more goods. So if the same amount of goods are being produced and you own the producers of those goods or of those services, generally you can tend to command more of a price premium. So they're able to raise their prices in response to inflation a little bit better than a traditional price taking business.
Mm-hmm. Got it.
Brad did his undergrad in economics, so there's your economics.
Yeah, exactly. The basics.
I gave you the investor answer. You gave you the economics answer.
Yeah. Well, it's super helpful for me. And as you know, our listeners, are kind of a mix of sophisticated institutional investors, but also students, people interested in this space that, might not be as steeped in these types of basic dynamics. And kind of another piece of that for a strategy like this that I just think is interesting, you talked about how a lot of the access to real assets is often in direct investments in private markets where you typically need larger checks to be able to invest in those types of funds. And so this also, I would think, gives smaller investors, smaller endowments, foundations, even individuals potentially the ability to access sort of these real asset strategies.
Exactly right. And that's what we've seen in our first fund and what we anticipate the second, because it will be structured the same way. So we've really seen a couple different types of investors in terms of why or, how they're accessing real assets come into these strategies. The first is that smaller institutional investor that you just mentioned who maybe doesn't have the size or the liquidity profile to do direct real asset investments. And so this is a great kind of composite or diversified approach to a real asset basket for them. It is low cost because it's an index fund. I think our traditional real asset fund is 25 basis points. This new one will be 35. So, compared to private investments, just a small percentage. It's also liquid. The fund has weekly liquidity, so you don't have any of those lockups.
Mm-hmm. And that's a big deal right now as there's so much uncertainty, right? A lot of endowments don't know where funding's coming from, what their spending's going to need to be like, right? So that's
right. That's right. And, but then we also see a second profile of client who is the larger institution who can go direct and does go direct in real assets. And the way we've seen them use this strategy to date is either to hold dry powder between deals, right? As you're waiting to do your next private deal, but you want to maintain that exposure to that inflation beta that we talked about. Or the second way is as a completeness fund. So maybe they're doing direct investments, but they're very specific, right? So they're not getting a broad exposure to a broad basket of real assets. We're getting something specific here and something specific there. And this is how they kind of complete their exposure to a real assets profile. So,
got it. Yeah, that's great. And while we're kind of on the topic of like different types of investors, what are you seeing? Where are you seeing interest in these, particularly the sustainable investing strategies? Like, is it across your investor types of endowments, foundations, and others, or are there certain segments that are more interested?
Not surprisingly. So a big part of our client base, about 60% of our client base is foundations and endowments. And so our existing clients, obviously, there's interest there, particularly those that we already see climate aligned in other parts of their equity portfolios. We also see OCIOs. We do a lot of work with OCIOs, and as they are providing sustainable models and solutions, we're seeing interest there. But we also see healthcare is another area that may or may not surprise people, that we often find these folks having a sustainable bent to their portfolios. And of course, family offices, a number of family offices that may or may not be connected with the foundations we know, just as their kind of their personal lens.
Yeah, so it's kind of across the board. That's great. This episode is made possible by Metis Global Partners. A global equity solutions provider managing over $5 billion, Metis offers both active and customized beta strategies for institutional investors. Through their guided beta product suite, Metis provides custom passive equity solutions to clients desiring sustainably aligned equity and real asset portfolios combined with a high-touch partnership. Founded in 2013 in San Diego, California, Metis serves a wide range of institutional clients including foundations, endowments, nonprofit, university, public plan, corporate, and family office clients. To learn more, visit www.metisgp.com. That's metisgp.com, or email info@metisgp.com. The Intentional Endowments Network's 2025 annual forum will take place on October 27th and 28th at Goucher College in Baltimore. This forum will convene 100 to 150 endowment, foundation, and sustainable investing industry leaders to discuss how to maintain intentional investing momentum at your institution, covering topics including system-level investing, the fiduciary duty case for sustainable investing, strong democracies and political risk, climate risk and opportunity, responsible technology and artificial intelligence, inequality as investment risk, and taking an expansive approach to talent. The program will be designed for endowment and foundation trustees, chief investment officers, and investment teams, as well as practitioners from investment consulting, outsourced CIO, and asset management firms. IEN events are intentionally designed to be highly interactive with plenty of time dedicated to dialogue at roundtables and networking, in addition to excellent presentations from experts and peer institutions. Go to intentionalendowments.org and click on Annual Forum to learn more. And what about, obviously we're sort of talking a lot in this political context. There's been this sort of big anti-ESG campaign over the last couple of years, which seems to have intensified with the new administration. Has that impacted this work much for you all?
I know that there's a lot of talk about housing. There's just a lot of everything I met, but we and me. From this, it's a function of what the client base is. Again, it leans heavy into foundations and endowments where folks want to align their overall portfolio with their overall mission. So we're not seeing that a lot. We're not seeing a lot of slowdown in those conversations. We're not seeing slowdown in investments in the strategies that we currently have or this new one. I think the other area that, will probably be tagged on here, asked about is, kind of the area of DEI, as we are a diverse owned firm. Again, we're not seeing slowdown in our momentum. That doesn't take away from our concern, obviously, about the types of conversations that have been going on out there. But,
right.
We're seeing, I think it's a function of perhaps the folks that we are either working with or, kind of have conversations with. I think they holistically, in many cases, just understand the value a decision-making apparatus that has a diverse lens. And by that, I mean that cognitive diversity that comes from all of those different factors, whether it's your gender or your socioeconomic upbringing or in your culture upbringing, what have you. And I think that's valued pretty much in most of the folks we're talking to, which is a broad range. It's not a niche range. So
yeah. That's great to hear. Are the nature of the conversations changing? Is there are you getting people saying oh, some members are bored or worried about sustainability or not even? It's just sort of they're on this path.
Yeah, it's we haven't had a lot of those direct conversations. Those may be happening between the OCIO and the board.
Right.
The OCIOs that we're working with, and we do direct work as well, but we haven't heard a ton of it. I know it's out there. I know I'm hearing other people talk about it, but so far, I think the work that we're doing is effectively solving problems and for folks.
Good.
In-home solve stuff.
Brad, what about sort of the broader, just some of the policies, with the kind of pullbacks from the Inflation Reduction Act and some of these things that we're seeing as drivers of, infrastructure and the energy transition? And are you anticipating that having a meaningful effect? Are you seeing any effect so far?
Yeah, I mean, I think you could see a pullback in the subsidies for some of the clean energy space. So some of the manufacturing tax credits might be under pressure a little bit for names like for solar. Um, but those names won't really be in this portfolio and affected as much. And I think, most investors and people who are constructing real estate and infrastructure understand the longer term need to be more energy efficient because it's also cheaper.
Yeah.
If you're more energy efficient, it'll be cheaper operating costs in the long run. So there's strong incentives, regardless of policy, to carry forth with these more sustainable options. So I think you might see some pressure in the short term, but over the long term, I don't think the case is impaired at all.
Yeah, that's been my sense. And it's, with the renewable energy costs getting so low too in so many areas, it's just going to be the best, cheapest option regardless of policy, hopefully. But it seems to me like, and from what I've heard, that momentum was strong enough to carry through. Might slow things down a bit as compared to having those incentives, which, is a problem when we're talking about climate and how much time we have. But yeah, it does seem like, and I guess that I didn't ask for this real asset strategy, the geography of it. Is it global or is it concentrated in certain countries?
It's global.
But yeah, that's big too, obviously, because there's different dynamics in all countries, but we get so US focused here often about what's happening in the policy environment here that it can be easy to forget that this transition's continuing to happen around the world. Nice. Awesome. So I'd just love to hear kind of as you are navigating this, talking to investors, looking at these different strategies, what has you the most excited right now?
Well, I guess we could take this a couple different ways. I mean, I think from the business side, I'll let Brad, because that this is one of the things I mentioned this up front that we are loving at Metis is actually having somebody so focused and knowledgeable specifically in this area. But so I'll have him speak to sustainable into that. But on the business side, I think what has me excited is just I'd say how the evolution of how clients are interfacing and how we're interfacing with clients in terms of these creative ways to collaborate and problem solve that frankly I don't remember 10 years ago, and I'm not exactly sure what that's all about. I know some of it's our business model has evolved, but I also just think there's this desire and sense to want to kind of collaborate and try to find a solution that works as opposed to something that has to be jammed in there. And that's the fun work from my perspective is creating things that actually are the best solution as opposed to. So we're doing that a couple ways. We're doing that obviously kind of in the one-on-one with the clients and CEOs, but also through vehicle expansion, which I'm really excited about because I don't know if folks that don't spend as much time in the investment industry realize this, but it's the vehicles that are literally the vehicles. They'll take you anywhere, right? And if you don't have vehicles, you can't go anywhere. And so adding things like ETFs or collective trusts for retirement specific. We have funds, but these are multi-purpose vehicles that are just allowing us to interface with a lot of different folks and get in there and have some more fun. So
yeah,
that's what
great.
I'm personally excited about. Yeah, and as a boutique shop, I think sometimes those things are undervalued. How relevant that is to really being able to maximize your solution.
Yeah. And it sounds like you can be really responsive too, right? I mean, you were saying that the real asset strategy kind of came out of conversations with a large client and then the sustainable version also sort of followed on. So
That's right. That's right. And now we're having conversations about those solutions in different vehicles so that they can solve for more of their client types as well. And so, yeah, it's collaborative and it's fun and really enjoying it. And I love that it's at this intersection of sustainability in this case.
Yeah, that's awesome. And so, Brad, how about you in terms of like the sustainable investing field and some of the work you're doing there?
Yeah, totally. So, as part of the process of designing this product and, finding sustainable alternatives to traditional real asset indexes, we noticed there weren't really any good options related to natural resources or agribusiness since, the nature-related data just really wasn't available like it is for climate and carbon emissions. So I'm really excited about the more widespread rollout of the TNFD in the coming years, which is the Task Force on Nature-Related Financial Disclosures. And I think we all saw the outsized impact that the TCFD had on company reporting and disclosure. And I'm hoping the TNFD will have a similar impact. I
Nice.
just
And
think,
again, just for the acronyms, that's the TCFD is the climate related financial disclosure. And now this is a similar model for nature related financial disclosure, right?
yeah, exactly. I just think climate and emissions have dominated sustainability topics and efforts for a really long time, and obviously with very good reason. But I'm really glad to see that natural capital and biodiversity are starting to get the attention they deserve. And I think, it all kind of starts with data and measurement. So by actually being able to track those metrics listed in the TNFD, the investment community can actually start engaging with companies to mitigate some of those, more existential and important risks like natural resource shortages, ecosystem collapse, and biodiversity loss.
Yeah, it is. It's been a huge growing theme, I think for years now, but it feels like it's starting to really get some traction and some standards, like you're saying,
Yeah,
to make it kind of more actionable. Nice. And did you say, does that relate to the real asset strategy? Did you say natural resources are a part of that? And so does that include things like sustainable agriculture and companies that focus on that?
Yeah, so we weren't really able to find any great options in that space, unfortunately. So our traditional real asset index has three sleeves for natural resources. So it's oil and gas, agribusiness, and timber, and then metals and mining. And so we were only really able to find a sustainable alternative for metals and mining, for metals that are essential to the climate transition. But we weren't able to find any other great options for the timber and agribusiness, really, in terms of solid indexes that have demonstrable KPIs and metrics that we could actually measure, because the company reporting just isn't super strong yet.
Gotcha. Yeah, I feel like there's a lot of strategies in timber and agriculture that are sustainability focused, but I guess they're mostly private market. That's sort of the limitation.
Exactly. Yeah. In the public markets, it's a bit harder.
Yeah, gotcha. Nice. Well, this is fascinating. Anything, we're going to have our few kind of final questions, but anything we didn't cover that you all want to make sure we talk about before we move to those?
Yeah, no, I think you did a great job of kind of just helping us illuminate the difference between a sustainable real asset fund and a traditional one. I think like the other sustainable index strategies that we manage, what was important to us is that these were methodologies that left space for evolution. Right? We know this is changing. The methodologies are changing, and we want the strategy to be able to participate in and enjoy the benefits of that evolution through time of, the quality of data, the types of methodologies. So it's a living, breathing organism. Even though it's an index strategy and it's passive, it's very much in the spirit and nature of, we're evolving with it.
Yeah, that's great. No, it's such a cool strategy. I mean, I think it's exciting to me because we're working with endowments and foundations that are taking this whole portfolio approach. And I think a lot of the attention goes to maybe ESG strategies in the public markets or impact strategies in the private markets. But there's so many aspects that if you're really trying to get your whole portfolio aligned, that I think products like this are really exciting, for, as you said, portfolios of all different sizes. So it's exciting. It's cool.
It's want to do a shameless plug, but just a shameless plug before you transition. For endowments and foundations that are interested in learning more about this, we do have a window of time left over the next month or two for founding investors, which get a substantial discounted fees, but also it's a forever discount. So if it's an area that you're trying to solve for in your portfolios, at the very least, we'd be happy to share what we've created. We think it's unique. There's nothing else in there, the market on the indexing side, that we've seen like this yet. So we're excited about innovating.
Yeah.
Being able to create something in this space.
Nice. That's great. Well, it's fantastic. And I would be remiss if I didn't thank you both for all the support you all have provided for the network. You guys are a leading sponsor of this podcast, as well as our upcoming annual event, which will be in late October at Goucher College in Baltimore, and our climate summit next March in Chicago. So really appreciate all the partnership around that. It's what makes it possible.
It's been wonderful being with this network over these couple of years, and just so supportive to us trying to build smart and well for the investors out there. So thank you so much for what you do.
Of course. Nice. All right. So here's our final quick question. Some on the kind of fun side. Well, fun if you're into this stuff, I guess. But if you could enact one federal policy in the U.S. to advance action on climate, or sustainability or social justice, which is kind of a snap of your fingers, what would that be?
Oh, that sounds like Brad's going to.
Go for it, Brad.
Yeah, no, I've got one that I think everyone can agree on. But it would just be, reducing the wait time and improving the permitting process for connecting renewable energy sources to the grid.
Mm-hmm.
So we have a really outdated system right now that was made for more, single large power generation structures like a natural gas or a coal plant. But now most of the interconnection queue is made up of a more distributed system of smaller solar and wind farms.
Mm-hmm.
And right now it takes anywhere from 2 to 5 years to go from the initial request to commercial operations, which is, obviously a very long time. And with solar specifically accounting for more than 60% of global electricity capacity additions, which is obviously very encouraging. If, the new solar farms aren't being connected to the grid, all of that CapEx and that investment really isn't being used as efficiently as it could be.
Yeah, no, it's a big one. And I think a lot of people are talking about Ezra Klein's book, Abundance, which sort of talks a lot about that and how we need to build these solutions. And it's exciting because it's the innovation and, kind of value add that we can drive these solutions instead of just talking about how bad the challenges around climate. But
Exactly.
yeah, it's a good point. That red tape, if we could find ways to move it along, would be good. All right. How about a book, podcast, article, or some resource that you think people who are interested in these topics should check out?
Yeah, I can handle that one as well. So one that I read a couple years ago that I really enjoyed was Investing in the Area of Climate Change by Bruce Usher. And it really talks about the critical role that investment and investors will play in reducing emissions and, some of the risks and opportunities that go along with climate change and the low carbon transition more broadly. So, I really loved it because it's an actionable and more optimistic guide for investors. And I think it does a really good job of, highlighting the recent advances in technological and business solutions that are really necessary and critical to reach net zero.
Yeah, nice. I've got to check that out. I was actually in touch with Bruce. I think he's a professor at Columbia about coming on the podcast to talk about some of that. So that's a great one.
He's great.
Yeah, hopefully we can get him on. Nice. And then work aside, what would we most likely find each of you doing when you're not working on these issues?
Brad would be outside. I'd be at a concert or traveling, most likely. Yeah. I'm a big traveler. We have family all over. And so if I'm not working, which is much of the time.
I was going to say, Machel, being in touch with you pretty regularly, I hope you're finding some time outside of work.
A little labor at your office nowadays. It really is. But so we're globetrotters. We just love to be in other cultures and just drop ourselves in and be with the locals, and that's what makes us happy. And
nice.
It's summertime, so like I said, you'll catch me at a outdoor music event somewhere probably. And the rest of the time I'm all wrapped up in Metis.
Working away. Yeah. Nice. Brad, how about when you're getting outside? We were just talking about your skiing and snowboarding. Is that sort of the main thing, or what else do you like to do?
Yeah, it's up there for me, but I'm also a big backpacker. The Eastern Sierras are breathtaking and stunning and beautiful. So I try to get up there a few times a year for a few days at least. And then I'm also very into sports, so I really enjoy playing beach volleyball, and I'm a big golfer. And then, maybe more in my downtime, I'm a really big reader. So that's how I spend most of my free time.
Nice. Awesome. Well, great. And then we have our two final questions we ask everybody, and you can either of you can answer this or both, but what's your vision for the future of finance, given all the challenges we face as a society?
Well, I think, and we've talked about this. Brad and I have been on several calls recently with an advisory board that we work with some others. And I think, what we'd really like to see, like many others, is just the silos and the barriers between, traditional investment teams and sustainable teams come down, and that there be full integration. I do think that's the way forward. Mm-hmm. I think that an investment analyst needs to be fully trained on both, your traditional financial models, as well as the elements of an industry's risk or opportunities that pertain to the sustainability, but ESG components of that particular engineering. And I'd like to see them together. It's where there isn't a conversation about let's talk to the unsustainable person, but it's instead let's talk to the investment analyst about the entire reflection of the company.
Yeah, it's a great point because it affects everything, right? So you can't really silo it out.
It really does. And I think with that, now we're a quantitative shop. And so with that, I'd be remiss if I didn't say I'd also really love to have, clear and consistent, quantifiable measures of sustainability and ESG over time.
Yeah.
But I think that actually comes about by the former of what we talked about, which is analysts who are, fully faceted analysts who are going to drive the innovation around how to capture all of this systematically and quantitatively and consistently. Because it really is just another element of the business's operations, and it needs to not be treated as something different or distinct.
Yeah, absolutely. Brad, anything to add on that one?
No, nothing else really.
Right on. And then how about advice you would give? You've both kind of navigated your careers very successfully. What kind of advice would you give to college students or young people looking to chart a path in this space?
I can handle that one. So kind of in line with what Machel just mentioned, but I think, for anyone coming out of college and interested in sustainability more generally, it's really important to understand, both the investing, the financial analysis, the accounting side of things, as well as the sustainable side. And it's going to be very helpful to understand how sustainability risks and opportunities interact with income and cash flow statements and balance sheets. So if you can do that, you'll be much more effective in understanding the impacts and working with investment teams and engaging with company management. And it'll be like a much more constructive process.
Mm-hmm. Nice. Perfect. Well, again, thank you both so much for taking the time to come on and share your work with us. And congrats on all the success and everything you're doing. It's really important work, so we appreciate it. And hopefully we'll talk again soon.
Yeah, we're looking forward to it. Thank you, George. We really appreciate the work you're doing.
You bet.
Thanks.
Take care. This episode has been brought to you by Metis Global Partners and by the Intentional Endowment Network's 2025 Annual Forum, taking place October 27th and 28th at Goucher College in Baltimore. Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.